thing I'd start with is welcome to Texas. Jay has been here before. We've had him here to the Dallas Fed. And so we're going to talk a little bit about Jay's background, a little bit about policy, philosophical and some leadership issues. But before we start, I always like to ask us at every one of these events, how many of you are coming to the Dallas Fed for the first time tonight? Wow. So that's great. And how many of you, the obvious, how many of you have been at the Fed before? All right. So one of the things we've tried to do with this series, and we'll continue doing it through 2019 and 2020, we've already booked speakers for the next couple of years. We rely very heavily at the Federal Reserve, as most of you know, on our interaction with leaders in the community throughout this district. And that's true of most of the other Federal Reserve banks. And while we do economic models and we have a great group of economists, I think our interactions with you are critical to our process in understanding the economy and making decisions on monetary policy. And I would tell you, it is our goal to have more people in this community throughout the state of Texas and the district here into the Fed, either here, San Antonio, Houston, or El Paso. So I just want to say to all of you who are here for the first time, welcome. For those of you who are returning, we hope you'll keep coming back. You are very critical to our ability to do our job. We're part of this community. We want to be a leading citizen in this community, and having you here means a lot to us, so thank you. With that, let me turn to Jay Powell. And let me just start, as Mark Wynn was saying, you were a lawyer, you were an investment banker, you were a private equity executive, and then you went to the Treasury. And I might have you talk a little bit about your career before coming to the Fed and how you got through those series of assignments in your career.
Thanks, Rob. First, let me say it's really great to be here tonight. Great to be back in Texas and Dallas. And I'd like to tell you that I had this great plan that I thought up at age 22, but that wouldn't be exactly right. I did have an idea, though, and that is I wanted to have a career which was mainly a private sector career, and then I wanted to do public service from time to time. And I had to model people like Jim Baker and George Shultz and people like that, Cyrus Vance, those kind of people. And that's all I had, right? So I got out of college, practiced law, went to law school, practiced law, switched into investment banking, and the head of my investment bank was Nick Brady, who became Secretary of the Treasury, and I wound up going to Washington with him, and that kind of got me started. I kind of sort of luckily had that chance to be mostly in the private sector, but now in the public sector. And I really think it's a unique feature of the American system that this happens. In most other countries, just about everybody in government is a career government person, which is, it's not a bad thing. But in the United States, we also have people coming in from the outside who had the experience of trying to get from point A to point B in the business world, and just knowing what it's like out there to be regulated. And so I think it's been a benefit. I've never doubted that that's a useful voice around the FOMC table, and I'm sure you haven't either, Rob.
No, I have not. And let me ask you, so how did you come to be a governor at the Federal Reserve?
So I left my private equity firm, and I went to work on a volunteer basis at a think tank, and I wrote a study on the debt ceiling and how it worked, because I saw the debt ceiling crisis coming, and I played a big role in briefing basically the Republicans on why the debt ceiling needed to be raised. And at the end of all that, the Obama administration, was very grateful and called me and said, we'd like to appoint you to something. And I said, okay, what do you have in mind? And so we talked about a couple things, and there were a bunch of Fed seats open, and I went to the Fed. It's at the end of 2011, then into 2000. So I joined the Fed in 2012 as a governor.
And you might describe for people, what does a governor do? How is it different than being a Fed bank president? What was your experience as a governor?
Yeah, so you can think of the Board of Governors in Washington as everybody is presidentially nominated and Senate confirmed. There are 7 offices. We rarely have 7 people. Right now we have 4. As of today, we may be getting our 5th. We're really excited about that. Mickey Bowman from Kansas joining us. And think of it as a senior management team. That's how I think of it, as a senior management team for the system along with the bank presidents. And so as a governor, we carve up all the work. There are a bunch of committees that govern the activities of the Board of Governors, and that there are system committees which are populated by people from the reserve banks as well as the Board of Governors. And you split that work up, and I wound up basically, as the years went by, other people left, governors rolled off, and I wound up inheriting all of their jobs, basically. So by the time Janet Yellen's term ended, I think I chaired all of the important committees but one, not including monetary. Of course, the Federal Open Market Committee, the chair always chairs, but the other committees, I chaired most of them. So I've done most of the jobs, almost all the jobs to be done in the system. The difference is, of course, being chairman, you can't do any of that committee work. And so I'm very focused on a handful of the really critical issues, which I would call external communications. It's just a very, very important part of my job. Also getting monetary policy right, getting financial supervision right, and also all of our external relations with Congress and the administration. So I invest in all those things and institutional issues. It's a pretty different job.
So one of the first things early on in your tenure, you made some changes regarding communication and transparency, announced that beginning in January 2019, we're going to have a press conference now after every meeting. And you also we established a new committee, which actually I'm on, chaired by Richard Clarida, to look at our communication and a number of our practices. So you might explain why did you make those changes?
I'll take you back a little ways. There was a sort of a theory and a practice of having a lot of mystery around central banking, and that was the way it was supposed to be. And then really under Chairman Greenspan, the thinking completely changed, and there's a lot of academic work on this. It's just better to have people actually understand and let the markets help you do your work and that sort of thing. So Chairman Greenspan did a bunch of things which opened the Fed up and made us communicate better with the public. So did Chairman Bernanke, so did Chair Yellen, and I'm just continuing that tradition. And I think it's really essential. I mean, I think the number one thing we've got to do is earn and sustain the trust of the public. And that means, be transparent about what we're doing and why we're doing it, speak in ways that the public can understand, and just go out of your way to embrace transparency and accountability. And by the way, bring some urgency to that job. So I'm doing that. And so the first thing I announced was doing press conferences, small thing, doing press conferences after every meeting, which gives me a chance to talk about what the Federal Open Market Committee decided, what we think about the economy, what we're thinking about, and just kind of engage after every meeting. So give people a better sense of what's going on. I've also done, I'm doing really quite a lot of outreach to Capitol Hill. In our system, our accountability is really to Congress. Congress created us, and that is our oversight on behalf of the American people. So I go up there a lot, and I talk to members and their staffs and try to understand what's on their minds and address their concerns. So it's a big project and one that I'll pursue throughout my term.
So up to now, for the last number of years, it's kind of been an implicit assumption that if the Fed was going to move on the Fed funds rate, it would do it on one of the quarter-end meetings, either March, June, September, December. Now with this change, should people assume that all 8 meetings are live? How should it change the way people think about our flexibility to make moves on monetary policy?
Well, so the market's definitely gotten in the habit of having us only move on press conference meetings, which is March, June, September, and December. But now there are going to be 8 press conferences, so over time the market's going to have to get used to that, and we'll have to be part of. We try to be transparent about our moves, and but certainly all meetings are live now. There's no question about it now. We have sometimes been reluctant to move at a non-press conference meeting because you'd want to be able to get out and explain why you did what you did, what your thinking was. So that's been our state of mind. We of course could have moved at any meeting at any time, but we didn't. So, but I do think over time, folks will get used to the idea that we can and will move at any meeting.
So as most people know, the Fed went for more than 8 years without any changes to the Fed funds rate. And over the last 3 years, we're now at a point where the Fed funds rate is 2.25%. And this is all part of the process of quote unquote normalizing monetary policy. What do you see at this point as the biggest challenge in normalizing monetary policy in the United States?
So again, I joined in 2012, and we were so far away from our goals. Unemployment was 8%, inflation was well below target, and So the direction of policy was pretty clear to me, and that was to keep rates low. We kept them low, as you mentioned, for quite a long time to give the economy every chance to breathe and to recover, regain health. 3 years ago, we reached the view on the committee that it was time to start gradually moving rates back up to a level that is normal for a healthier economy. And I think I'm very happy about the state of the economy now. And I think part of that is that we have moved along. Our policy is part of the reason why the economy is in such a good place right now. We have 3.7% unemployment. The economy is growing at 3%. Inflation's right on target, and there's pretty good reason to think that we're going to continue, in a positive vein like that. So very pleased about the state of the economy right now. I think if you look forward, if you look down the road, you see challenges ahead, and they're challenges that are typical of this point in the cycle, and that is we have to be thinking about how much further to raise rates and the pace at which we will raise rates. And I think the way we will be approaching that is to be looking really carefully at how the markets and the economy and business contexts are reacting to our policy. We'll be looking, at the incoming data across all three of those sources to tell us whether our policy stance is appropriate. And our goals will be to, extend the recovery, expansion, and to keep unemployment low and to keep inflation low. So that's how we're going to be thinking about it.
So and I might just emphasize and follow up on one of the things people may not realize is that our primary goal is to try to extend this expansion. And we'll talk about misconceptions later, but how does what we're doing in your mind help extend the expansion?
We've been gradually moving again back up to normal kind of rates. And the record shows that there's sort of two kinds of errors, and we're trying to steer between them. One kind of error is to keep rates too low for too long. You can wind up getting imbalances in the economy that either show up in forms of inflation or in the form of financial imbalances. If the other mistake, and we had plenty of advice to do this, is to raise rates too soon and prematurely terminate an expansion. We haven't done that. But we're at a point now where we have to take both of those risks very seriously, and that's why we've been raising rates again quite gradually.
And so, along with these moves on the Fed funds rate, we announced at the Federal Open Market Committee last fall a plan to reduce the balance sheet and let it run off. And for those who are not familiar, not by selling securities, but simply by not replacing Treasury mortgage-backed securities as they mature. What's your assessment of how we're doing so far on reducing the balance sheet, and what do you think are the prospects for progress there the next couple of years?
I think that our plan to normalize the balance sheet is going very well, and it has. I think we were concerned in the run-up to announcing it that there would be strong market reactions and tightening of financial conditions more than we would like or expect. That hasn't happened, and so it's very important that we return the balance sheet to a smaller size. We said we would do this. It's large because of all the securities that we bought as part of the quantitative easing program, which drove down long-term rates and supported economic activity. But we said we would reverse that process and get back to a smaller balance sheet, and we take that seriously. So I think it's moving along very well. I think we don't actually know what the equilibrium size of it will be. In the longer run, the balance sheet will depend on public demand for our liabilities, which is to say currency and reserves. Reserves are just overnight obligations that we issue that sit in the reserve banks in the form of cash, actually. And banks really like them now. The demand for reserves is much higher. So we are in the process of returning to a smaller balance sheet, and I'd say we're on track to do that.
So there was a lot of press about a speech that you made at our annual conference at Jackson Hole in August, where you spoke about a few theoretical concepts we use: the neutral rate, the natural rate of unemployment, and you spoke about and cautioned about the imprecision and uncertainty around those concepts. Why did you give that speech, and why did you emphasize those points?
What I really was trying to do was bring the subject of risk management to the front there, and talk about what an important role it plays in making monetary policy. And just to give the quick version of it, we have a couple of concepts that we really need in thinking about the economy. One is just the natural rate of unemployment, and that's the rate at which if unemployment is lower than that, then in theory you would see inflationary pressures build up. If it was higher than that, then you would see inflation maybe declining or below target. And the other one is the neutral rate of interest. And so if in theory, if the rate of interest were below the neutral rate, then it would be stimulating the economy, we'd be pushing up on the economy. And if we're above the neutral rate, it would be pushing down to slow down the economy. So we need those two concepts because, that's how we think about the economy is, unemployment's just a number. Is it too high or too low? It's got to be relative to something. And the same thing is true of the rate. So my point was just to say that we don't measure these things with any precision. We look back 20 years later and we know that, we were off by a mile on that. So how do you make policy in an environment of great uncertainty? And there's been a ton of work done on this. And you basically you've got to be thinking about not just the baseline case and making policy for that, but what if things go wrong? And often the risks are asymmetric, and you need to have that in your thinking. So, a good example is a non-economic example would be you're walking through a room full of furniture and the lights go off. What do? You slow down. You stop probably and feel your way. So it's not different with policy. When there's much more uncertainty, in some cases you're going to want to do less, in some cases you're going to want to do more, and I talked about some of those. So that's what the point of that was. It was a lot of fun writing that speech and delivering it, I have to say.
Let me talk about a few elements that there's been a lot of press about and all these we talk about around the FOMC table. And let's start with trade. There's obviously been a lot of discussion over the last year about trade policy. How does it affect our thinking about monetary policy?
So first, I have to start by saying we don't have responsibility for trade policy. That's outside of our lane. But it does. Trade, of course, is a really important factor for the economy. And I would be of the view, and I think many of my colleagues are of the view, that over a long period of time, our economy has benefited significantly from trade. Trade drives productivity. It lets businesses sell their products, and people buy products from all over the world. So it's a positive thing. But we also know that trade needs to be both free and fair. So I guess I would just say that if this process that's going on right now winds up with lower tariffs and better observance of agreed trade rules, then that would be good for our economy and good for the world economy. If instead, perhaps inadvertently, it winds up in a place where we have more widespread protectionism around the world, that will be bad for our economy, and that would be unfortunate. In terms of what you really asked about is the near-term effects, and we don't see much. Of course, we hear a lot from businesses about higher costs, about loss of markets. We see a rising chorus of concern, largely through business contacts, through the reserve banks, but also our own contacts. It hasn't shown up yet in the data. Of course, it would be hard to see it in the data because you don't know what the data would have been without the trade issues. But in theory, you could see a little slower growth. If to the extent that more and more products are subject to tariffs, you could see a little bit higher inflation and a little bit lower growth.
So another thing that's going on, we know that there's concern that global growth is decelerating. Growth outside the U.S. is decelerating. The dollar's been very strong, which has also created some strains. Obviously, trade policy has probably had some strains on export-driven economies. How does potentially decelerating global growth and the strength of the dollar affect our thinking and your thinking?
As many here will have firsthand experience of, our economy is now woven tightly into global supply chains in a lot of ways. So, growth abroad means a lot for our businesses who may source raw materials or sell products abroad. So, the strength of the global economy is very, very important. As you noted, I think 17 was a good, strong year for global growth generally, not for every country, but a very high percentage of countries experienced good, solid growth in 17. And there was a lot of optimism at the beginning of this year. I think this year has seen a gradual chipping away at that picture. You've seen a bit of a slowdown, not a terrible slowdown. You still see solid growth, but you see kind of growing signs of a bit of a slowdown. And it is concerning. So we monitor it. Of course, our mandate is for U.S. economic conditions, stable prices, maximum employment, and financial stability. But it's really important what happens around the world. I think roughly half of global economic activity now takes place in emerging market countries, including China and India, and far more than half of the growth in the world comes from emerging market countries. So what happens in those countries and in our old advanced economy allies really matters for us, and we watch it carefully.
Stock market turmoil, which we've had some volatility, obviously, for the last number of weeks. A number of us, we watch markets very carefully. How does it affect the thinking around the FOMC table in terms of analysis of the economy and implications for monetary policy?
We're looking mainly at the real economy, inflation, unemployment, growth, and those kind of things. And of course, financial conditions and financial market activity matters a lot for that. And it's not just the equity markets. It's also, really importantly, the debt markets and levels of interest rates and credit spreads and things like that. They all matter. As you know, Rob, we monitor all that very carefully. I think the equity markets get a lot. It's a very high profile thing. And it does matter for the economy. Of course, companies can finance their business in the equity markets, and investors own equities. And when equity prices are high, people are going to spend a little bit of that. It's not a big change, and typically, people would need to think that increase in equity values is sustainable and sustained before they would spend much out of their wealth. But there is an effect. So when prices get down or go down or go volatile, we do pick up an effect. But it's one of many, many factors that go into a very large economy, and so I just say it's one of many factors.
And along with that, credit spreads, health of the credit markets, fixed income spreads. How does that affect our thinking? They have not, by the way, up to now with the turmoil, they've held in pretty well. Maybe there's a little bit of widening recently. How would that affect our thinking if that situation changed and you saw credit spreads gap out?
So for those of you who maybe don't work in the financial markets, a credit spread is just the increase. So if the Treasury borrows here, then private sector companies are going to borrow a little bit higher, and the difference between the two rates is called the credit spread. Credit spreads have been very tight, which is to say that investors are feeling optimistic, and they're not getting paid a lot to take that incremental risk, and so credit spreads have been fairly low. That's partly because the economy's been so good, and it's just something that we monitor. When credit spreads are low, they can sometimes move up quickly, and that can have negative effects. But in the meantime, it means that companies can finance at very low rates.
So on this, a number of bankers in this room, just looking around the room, and obviously we do a lot of work at the Fed on regulations, and recently there have been a number of initiatives to reform regulatory policy, and particularly as it affects big banks versus small banks. What are your views on regulatory reform? How would you describe what we're trying to do at the Fed, and your thoughts on how regulation needs to be updated, changed, modernized regarding big and small banks?
I think that the reforms that we've done for the largest financial institutions are some of the most important things that we did after the crisis. And we have 4 elements of reforms for the very largest institutions that I think are important, that are really at the center of it. And that's much higher risk-based capital. It's much higher liquidity, much more liquid assets. It's stress tests that force institutions to understand their risks better and be able to manage them better. And then it's resolution planning in case it all goes wrong and the company has to go bankrupt to be resolved. So those are the 4 pillars of post-crisis reform, and we want to maintain those and keep them strong. I think we also want to look at, again, just talking about the largest banks now, we also want to make sure that everything we've put in place is as efficient as it can be. It doesn't make regulation better to make it inefficient. So there's a lot we can do. We put a lot of things into place really, at a very fast rate over a 10-year period, and it's appropriate to go back and make sure that it's all efficient. Things can, and I would single out the Volcker rule as a rule which will remain in force, but will be more efficient when revised, and that applies mainly to the big banks. As you move
And
away,
just for those, it's the proprietary trading limitations on big banks.
right? It says that you can't be in the proprietary trading business if you're a bank. So as you move down into the regional banks and the smaller banks, we're looking to make what we're looking to do there is that we think that it's important to tailor regulation so that banks that don't present the potential failure of which don't present risk to the whole financial system. So smaller institutions, they shouldn't have the same regulatory and supervisory expectations of the very largest banks. So we're looking at banks that, the regionals, the smaller regionals, the sub-regionals, and the community banks all the way down, and making sure that at each step we are appropriately tuning our expectations and the level of regulation to the nature of the institution, the risks that it's running, the businesses that it's in. And that's really the heart of what we're doing. So, and I do separate it into the very largest institutions and then the others.
So related to that, one of the lessons from the financial crisis, the economic crisis, which led to a financial crisis, is the impact of financial stability. So obviously we talked about bank regulation. I see we've got a question from the audience about the shadow banking system, which is related to that. Why is financial stability so important, and what's the most important lesson that you learned from the downturn and the Great Recession we went through about financial stability?
I think all of us collectively maybe suffered from a lack of imagination about what financial instability could look like in a modern financial system. And we saw what it can look like in 2008. And I think the takeaway is that without financial stability, you can't really have economic stability at all. So financial stability is sort of a necessary precondition to having a healthy economy. And but what do we mean by financial stability? Well, I think I would say what that means is that when there are stressful events and stressful times in the real economy, the financial system can keep doing its job of providing credit to households and businesses throughout even stressful times, as opposed to what happened in the crisis, where the financial system itself became an amplification mechanism for the economic downturn. Really, what happened was there was a run on the financial system, and that made the pre-existing economic downturn so much worse. So financial stability, we built an entire division at the Board of Governors around monitoring financial stability and trying to address financial stability concerns. It's a very high-profile concern, and it really, interestingly, it wasn't actually before the crisis because, again, people didn't see this coming. They didn't see the vulnerabilities. Well, we see them now. We found out the hard way.
Related to that, what's the impact in your thinking of high levels of government debt to GDP? We know since the Great Recession, the household sector is deleveraged. Corporate debt is higher, which is something we watch, but government debt to GDP is dramatically higher, and the present value of unfunded entitlements is now $54 trillion. How does that affect your thinking about monetary policy and our job at the Federal Reserve?
So let me say that the U.S. Is on an unsustainable fiscal path. That has been true for a long time. That is associated with our uniquely expensive healthcare delivery system and our aging population. And it's not something we have control over at the Fed. I would say also these fiscal sustainability questions are problems for the medium and near term. We will have no choice but to address them eventually. The sooner we do, the better. They don't really enter into a business cycle thinking, which is really our time frame is really, moving interest rates around to try to sustain this recovery. And when the economy's weak, trying to support it. When the economy's overheating, try to prevent it from doing that. That's more of a business cycle approach to the economy. So it doesn't, at least now, fiscal unsustainability hasn't really affected our job and doesn't really play much of a role in my thinking anyway on monetary policy.
All right, so if I turn on the television or I read the paper some days, people talk about decisions that Jay Powell's making about interest rates. They hope you'll make the right decisions. And I sit in the room with you, and this is under the heading of misconceptions about the Fed. You might explain to people, what is the process for making monetary policy decisions? What role do you play? What role does the group play in making these determinations?
The thing I would say is we have a really tremendous team. There are 12 Reserve Bank presidents and now 5 governors, 4 other than me, and terrific senior staff. I actually played a role in the selection of the last 8 Reserve Bank presidents. I think it's a tremendous team. If we do something wrong, it's clearly my fault. But I also think of it as collaborative. I'm somebody who really likes to hear disparate views. It really helps me to have somebody really smart explain to me why this is a bad idea. And that's part of the way I get to a place where I decide that it's a good idea, is if I can hear those arguments made in a really strong form. So I think we have really good discussions at the FOMC, but it's a group process that I have to lead. I've got to provide direction for it, but I want people to bring their own ideas as strongly as possible. I never discourage anybody from saying things that are, sort of dissonant in those meetings. So, I mean, it's a group process. It's not like, I wave a magic wand. Actually, sometimes that does happen.
All right, on that note, what are the other big misconceptions about how we make decisions and about monetary policy? What are the ones you hear that you say, oh my God, it just isn't that way?
I would turn it around. I would just say, central banking can be pretty far from people's daily lives, and can be something that they can and probably should go on leading their lives and not know a heck of a lot. I mean, I managed a big part of my life without knowing exactly how the FOMC works. But so the public doesn't know that much, and really does. That's not on them. So I think you get a lot of questions. When I was a governor, the question that I always got was, "Is that a full-time job?" And I would usually say, no, it's 3 full-time jobs. But that was because I think people think, oh, that sounds like being, a director of one of the reserve banks, which is a part-time job. And, no, being a member of the board of governors, a director of the Dallas Fed, for example, doesn't spend 100 hours a week on that. At least I hope. So that's the main one I know.
So let me throw out some misconceptions that you might hear occasionally. One is we are dominated by academics and we are not as tied in to what's going on in the business community. I'll throw that one out, let you respond to that one.
So I think if you look at I believe we need diversity of backgrounds and perspectives on the FOMC. And so we need a lot of great PhD economists, and we have them. But we also need people like you, Rob, and people like some of our other, seriously, with a tremendous career in business and in academia, but no economics PhD. We need people who have done different things. I think we have an extraordinarily good mix right now of people, both very strong economists and people from the business community who've also spent time in academics, and I think you need diverse perspectives, that's all. And I can't, I mean, my background was very much working on transactions, and so for me to think about the economy, it has to start with understanding what people how they're thinking about their businesses, and you must have the same feeling. It doesn't make any sense until you can kind of get a feel for the tone of the economy through the eyes of people who are actually economic actors.
How important is debate and disagreement?
It's utterly essential, as I mentioned. I'm a lawyer's kid, so I would think that. And I was a lawyer, but I really do think you get to the truth when you have people who are well armed, arguing things out, and you hear the arguments in their strongest form, and then it really helps you kind of peel back what you know and what you kind of think you know and that kind of thing. So I think it's completely essential. I will add. So the fact that we have 12 reserve banks around the country with 12 economics faculties, it pretty much guarantees that we will have a diversity of perspectives at all of our meetings. It's absolutely essential. It's a great feature of our system.
Fed independence, what does it mean and why is it important?
So what Fed independence means, it just means that we have legal protections so that our decisions can't be reversed by the administration. Of course, Congress can do whatever it wants. We're a creature of Congress. Our terms don't run at the same time as an election cycle. So we have a degree of independence. We have protections from political involvement and that kind of thing. The reason it's important is that it enables us to serve the public better. And there's a very clear record around the world. Central banks, when they get too close to the government, the incentives change and that kind of thing. So you want the central bank to be apart from shorter-term political considerations, but you also want it to be as transparent as possible and as accountable as possible in a democracy, and we understand that. So the other side of the independence coin is that we have to embrace transparency and pursue it, and really engage proactively with our overseers, who really is Congress in our system, as I mentioned. It's really Congress that has that responsibility, and we want them to know that we understand that, and we want to hear their concerns and address them to the maximum extent we can.
And so one of the questions from the audience is, gee, I read in the newspaper that you have been mentioned by political leaders over the last several months.
That was very delicate, Rob.
Yes. Subtle. What effect does that have?
So, we have a very important job that Congress has assigned us, and that is serve the public through maximum employment, stable prices, in a stable financial setting. And we have the tools to do it, and we have the protections to allow us to do that without political involvement. And that's our job, and that's our sole focus. We don't try to control things we don't control. We try to control the controllable. And so, we're just trying to do our jobs, and we're doing fine.
All right, and before we go to verbal questions from the audience, I'm going to ask you about a couple of other topics. You have been a leader in trying to create more diversity and encouraging more diversity in the Federal Reserve System. And each of the banks, including this one, has worked very hard on trying to do that. Why is diversity important to the Federal Reserve?
I think it's very important. And frankly, my experience in working with companies around the country, you may have had the same experience, is that the really good companies get this. It's, having a diverse and inclusive culture is what lets you recruit the best people now. The best kids coming out of school, they want this. They need this. And that's the country we live in now. So it's nothing but an asset for the Fed. And I'm proud of what the reserve banks have done and what we're doing. And I just think we need to embrace that. It's, as I mentioned, having diverse perspectives is absolutely essential in making decisions. And having people feel, free to speak, included in the discussion. If they don't feel that way, then it doesn't matter that they have diverse perspectives. They have to be willing to speak up and bring their disparate views to the table.
I'm going to take one other question from the audience here. How do you balance using statistical, and I guess I'd paraphrase, economic data, which there's a lot of it, versus anecdotal data and all the work we do in our surveys and talking to business leaders all through the country, which we do extensively? How do we balance those?
I think a couple things. I think you get talking to people in the economy, you get things faster. The data tend to come in later. They tend to take a time. Some of it particularly comes in a lot later. In addition, a lot of times the data will come in and then it'll be changed 2 months later. So you think you had a story, and sometimes there are 2 or 3 iterations of, for example, how payroll hires in a given month. It's re-estimated periodically as the better data come in. So I think you pick things up sooner talking to business people because they start to feel it, and then it shows up in the data. Also, as I mentioned earlier, for me, in my investing career, it starts with one management team and one company and products, and then competitors and suppliers, and then you sort of work out to the broader economy. Macroeconomics goes the other way. It goes from the outside in, and so it definitely helps me to get the story better in my own thinking, to hear anecdotal stuff. But you need both. You need a lot of data too.
So on that, let me just take a couple examples. We obviously are seeing in the economic data that housing sales are slowing, and we know, talking to home builders, that they're concerned about it. They cite a lot of things: input costs. They also cite mortgage rates, and there's some concern that this is a forward indicator of what might be coming in terms of potential economic slowing. How do you think about this as an example of looking at economic data and talking to business people, trying to figure out what's going on out there?
Yeah, we meet regularly with people from all different sectors, including the housing sector. And you said it. I mean, there's a lot of factors weighing on home building right now. It's material costs, it's labor scarcity, it's difficulty in finding lots, it is rates as well. Now, I think rates are up. They're still historically low, but rates were so low for so long, some people have never seen a 5% mortgage. So others of us remember a different world. But so that is definitely the case. They're facing a softening environment. And so we're monitoring that. If you go back 25 years, housing was a really big part of the economy, and it was a big cyclical driver. I think it's less so today, but it's something we're watching carefully. It's an interest-sensitive sector, and as our policy path has moved along, we try to keep an eye out for sectors like that to see the effect we're having.
You served on the board of the Nature Conservancy, and the Bank of England has done a lot to talk about sustainability, tail risks to the economy, and how that even may affect monetary policy. How do you think about the relationship between the economy and the environment?
I think, first of all, let me say it's not our mandate, but at the same time, I think we have an obligation to run our institution, as we all do, in a sustainable way. I think in the long run, this is just something I personally think we need to do for posterity. It's not really, we can't address global warming and things like that with monetary policy. But it's an important value, and I think we should show it through our own operations, really, to the maximum extent possible.
All right, let's take some questions from the audience. And this gentleman here, have you been waiting? No, okay. All right. So you have to go to a microphone. Sorry about that. Yes, right here on the side. Yeah, yes, please.
Hi, Jennifer Christ. I have a question. You mentioned the impact of regulations on both large and small banks, and one large shift within regulation of expected credit loss as opposed to the incurred credit loss and the CECL implementation in 2020. From your perspective, I'm very curious on your thoughts when it comes to things like capital markets and the macroeconomic variables maybe magnifying some noise or fluctuations within markets. What impact do you think CECL could have if there are certain macroeconomic variables that show signs of deterioration and the market contracts and maybe causes a waterfall effect? And then as a second problem...
Well, actually, if you don't mind, because we want to take as many as we can, let me just explain in 15 seconds. CECL is basically a change in accounting standards that is causing banks to increase the level of reserves they take for every loan, and there's some concern it might be an impediment or discourage bank lending. Fair enough.
So let me just say that it's a good question. It's a fair question. It's a really technical question. And it's one that we are, we're taking a look at that right now. That's really all I can say. Is that we're alert to the issue you're talking about, and we're taking a careful look.
Yes, sir.
My question's a lot more basic. I'm drawing on my very old economics degree from like 30 years ago, and I'm trying to remember, is there ever a situation where the Fed would consciously invert the yield curve, and what would that scenario look like?
So the yield curve, for those of you who haven't been reading about the yield curve, that just means short-term rates are higher than long-term rates. I don't know the yield curve has inverted many times. I suppose it didn't happen unconsciously. I don't know whether people were doing it deliberately. But the point of it is that, to me, the way I think about it is, so we know why short-term rates go up and down, and significantly that's because of what we're doing with our short-term policy rate. The real question is, why is the longer-term rate lower? That's the question, and what's in. So a lot of things going into setting long-term interest rates. One of the many things that goes into setting a long-term interest rate is an assessment of what the longer-run neutral short-term rate is. So if the yield curve is inverted, that may mean that current policy is or is expected to be tight, which is to say higher than that rates, that you have rates that are actually higher than the neutral rate, so you're deliberately slowing the economy. So that's what it is. It's it's happened many times since World War II, as you know.
I guess the point of that is I'm a financial advisor, and one of the old adages is bull markets don't die of old age, the Fed kills them. So that's really the question. So,
Well,
it may happen, and that at that point.
Yeah,
it's
let me just go.
No, go ahead.
Let me just say that's not a decision that anybody has made. We're going to be making policy as we go forward. We're going to be looking at incoming data from business contacts, from financial markets, from the real economy, and trying to set policy to extend the expansion and keep us near 2% inflation and maximum employment. That's what we're going to be doing. And we don't make those decisions until we get. Those are decisions that are ahead of us, and we haven't made them yet. So
Okay. Well, thank you.
I'll ask a follow-up because it begs, and we debate this a lot around the table. Do you want to avoid an inverted yield curve?
It would depend on the underlying macroeconomic reality.
Okay.
I mean, I think if in a perfect world that question would never arise because because the economy you wouldn't need to invert the yield curve. Right.
Okay.
Thank you.
Yes, sir.
Chairman Powell, welcome to Dallas.
Thank you.
President Kaplan, thank you for hosting.
Thank you.
We are in Texas. I know oil is not as big as it used to be, although it has made a big return on the economic scene. A lot of U.S. dollars used to flow out of our country. What do you feel the impact is of those dollars staying here now on the third world, emerging markets, and other international economies that, if you listen to the financial press, are starving for U.S. dollars?
I don't know that there's a dollar shortage anywhere. I mean, people.
Well, with the dollar tightening, the dollar increasing,
Yeah.
And a lot of that debt being funded with U.S. dollars, and now all the other economies having to deal with that translation from their currency into U.S. dollars, we're keeping a lot of that money here. And I understand there's a lot of flow that has to go once the dollars used to go out to pay for oil, but a lot of that oil money used to be used to finance and repay those debts.
I think
Now
the
it's not
issue
there.
is that the U.S. economy is just really strong, and it's stronger than many other major economies right now. And so naturally, that puts some upward pressure on the dollar. Dollar really hasn't moved up much, but it definitely puts some upward pressure on the dollar. So many countries have borrowed in dollars, and when the dollar goes up, they've got to pay, and their currency doesn't go up as much, so it's harder for them to pay those debts. So definitely a strong U.S. economy and increasing interest rates here push the dollar up, and it tightens financial conditions for emerging market countries in particular, and they're feeling some of that now. But we've tried to be extremely transparent about our intentions, and so I think generally that's what we can do, because a strong U.S. economy is good for the global economy.
Great. Thank you very much.
Yes.
Chairman Chairman Powell, thank you for being here. I'm Dustin Mohite from Sheldon Capital. My question is about the LIBOR-OIS spread. 2018 has seen the spread widen out to 2008 crisis levels. Is the Fed monitoring this? And if so, what is the Fed's interpretation of this?
A lot of technical things drive LIBOR-OIS move around. It's not. I don't think it's. I mean, it happened during the crisis because of big concerns about the creditworthiness of banks. There's nothing like that going on right now. So,
Thank you.
Yes, sir.
Hi, I'm John Vandermosten with Zacks. I'm an equity analyst. Just a question on low interest rates over a long period of time. One of the criticisms of that is that it creates imbalances. And how does the Fed determine whether or not imbalances like that exist? And then how do you respond to them?
So we monitor financial stability really carefully. We have a framework that we look at. Rob and I get briefed at the FOMC every other meeting on this framework. We were just briefed on it last week. And, so here are the things we look at. We look at asset prices, and I mean a broad range of asset prices. We look at leverage in the financial system. We look at borrowing by households and businesses. And then we look at sort of vulnerable funding structures. And so, and if it turns out if you kind of lump those four things together, you really got common characteristics that show up in almost every financial crisis. So, they seem disparate, but these are the familiar faces that show up all around the world for the last decades in financial crises. And if you look at all that, it comes out to a pretty moderate picture, actually. There's not a lot. The leverage in the financial system is much lower than it was. Households are in good shape from a leverage standpoint. There's some significant corporate borrowing, and we have our eyes on that.
Maybe the government borrowing?
That's not that's not in our framework, but
Right,
that's
right, no, I
that's a different thing. But that's an important subject, but a different one. So my point would just be we monitor it really carefully, and we're looking for the next financial vulnerability all the time, we'll try our best to find it. But of course, it's always different the next time.
Thank you.
Jerome Powell, my name is Johnny Atos. I help run Investors Club of old guys like me. And the question is, the news channels, business channels keep on discussing this, that you are making decisions today that will affect the economy 18 months from now. And my question is, what data are you looking at now that will tell you the results of your decisions 18 months from now?
So this is the point here is that we believe, and there's a lot of evidence for this, that when we make a decision and we raise interest rates, it actually takes some time for the full effects of that change to show up in the real economy. Maybe 12 months, maybe 18 months. Famously, someone said, I think it was Keynes said, long and variable lags. Someone said that anyway, long and variable lags.
Right.
So that does complicate things, because you don't have immediate data. The good thing is we know that. We know that, and that's one of the reasons we've moved so gradually, is that we know that the real effects are going to show up. They're in train, and they're going to be showing up. So you don't have immediate data on that. You do know how much financial conditions are reacting in real time. So you know that, but you don't really actually know what the real economy effects will be.
And I might follow up with you. So let's talk about what are some of the headwinds you worry about, or potential headwinds that might develop over the next 18 months, 2 years that you're watching, is to see how they develop. Yeah.
So slowing growth abroad, that's a real thing, as you mentioned. I also, the fiscal changes, the tax cuts and the spending increases that were enacted at the end of last year and the beginning of this year are providing some real boost right now. That impetus is going to wear off over time, in the sense that you may have activity at a higher level, but you won't be growing as fast. So growth may slow down, although again activity will be at a higher level. So that could be happening in the next year or so. And another one is just as the gentleman asked, is the lagged effect of our interest rate increases can be showing up. So these are things we're well aware of, though. We know that when we're making policy, and we think about those and kind of have a sense of what they might be.
Thank you.
Sir.
Mr. Chairman, Ray Jennison, First Canterbury. Some would say that the good economy we're experiencing is due in some small part to the reduction or the relaxation of regulation. And I believe I heard you say that you're for fine-tuning banking regulation, because that which applies to large banks may not apply to small banks. I agree. My question is this. Does that fine-tuning of regulation also apply to financial brokerage firms? And if so, when can we expect it?
So we don't have the honor of supervising or regulating financial brokerage firms.
I'm aware of that. I was hoping.
I can't help you there, sorry.
So let me take one right here.
Chairman Powell, I'm a technology executive here in Dallas. The question I have is, even as the Fed seeks to foster economic growth for the nation as a whole, do you worry about how the benefits of that economic growth are shared equally amongst everyone? And does a growing economic disparity in the country have any impact on the Fed's decision making?
So we are very aware that while the economy overall is doing well, that doesn't mean every demographic or every industry or every geographic region is doing well. So we know that there are a lot of people that are around the edges who have not benefited yet from the recovery. The longer the recovery goes on, the better for those people. I think we're now seeing people around the edges of the labor force getting pulled in and having employment opportunities. And I hear that in anecdotal data, and it's also in the real data too. So that's a real thing, and it's a great thing. So the best thing we can do is to try to sustain this expansion for as long as possible. And that's really what our policy is designed to do. We don't have distributional tools. I do think that you want broad prosperity. You want prosperity to be spread. I want prosperity to be spread very broadly. And I think the combination of globalization and technology and the stagnation of educational attainment in the United States has led to levels of really economic stagnation for people with lower education levels that are really a problem and a national problem that we need to address.
You might explain that last point, because we talk a lot about this. How are globalization and technology, and then maybe not doing as well in terms of our education system as we did decades ago, how's that, and skill training also, how's that affecting what you just said?
When technology is advancing all the time, it has been for more than a couple centuries, but we've been in an era, really, in the modern era, and when society educates people and gives them the skills and aptitudes that they need to benefit from that technology and use that technology, then you can have rapid technological growth and also rapid income growth and also declining inequality. And that's what we had for a big part of the 20th century. What happened is in the 1970s, U.S. educational attainment, which was the highest in the world, we had the highest educational attainment in the world. We're the first country to have gender-blind secondary education, universal gender-blind secondary education. So U.S. educational attainment just flattened out since the 70s. At the same time, the rest of the world was catching up from an educational standpoint, and at the same time, the economy is globalizing so that jobs can be done everywhere. So what you have is stagnation of median and lower incomes in the United States, and you have people at the top who the so-called college premium, which has just never been higher. So what that says is, the only way you can compete in this global economy is by having the best workers and the most educated workers with the skills and aptitudes to benefit from technology. And that is a huge problem that we face. That's really where the problem we need to address, a problem we need to address.
Thank you.
So we're going to need to wrap up here, and I'm sorry I didn't take every question from the audience here. But let me ask, as we close tonight, Jay, if there's one message you'd want to deliver to the audience, something that you'd like them to take away from this meeting tonight as it relates to the Federal Reserve and the way you think about being chair of the Fed, what would be that message?
I might give them two messages, if that's all right.
You're welcome. You're in Texas. You can do as many as you want.
So I think I want to leave on a note of optimism about our economy, and we've been through a difficult time, and we've faced difficult times before. We're in a good place now, and I think I do believe our economy can grow and grow faster. And I think you always want to be on the optimistic side of this economy. We have so many things going for it. We travel around the world and we see the problems that other countries have. You'd always want to come home and take the hand of cards that we have. So I want to certainly say that. From the Fed standpoint, I would just want you to take away that we are absolutely committed to serving the public in a nonpartisan, professional way, in a way that communicates what we're doing, why we're doing it as clearly as possible. And some of you have had involvement with us. You're involved just by being here. I thank you for that. We benefit enormously from your involvement. So thanks very much for being here.
Jay, thank you for your leadership, and thank you for being here.
Thanks.
Good job.
Good job. You too. Appreciate it.